our set of customer, which is our typically a mass affluent customer, and that can which help the customer to build an wealth, over a period of time. So without much wasting time, I would request Saurav to please come and share a few words and take us through this journey of what is this MeritorQ and how our customers can actually look forward for a long-term investment with a portfolio addition into this wealth management.
Thank you, Shojit. Thank you, IIFL, for hosting us today. Or with me on this call, our investment advisor Krishnan. He's the brains behind MeritorQ, and Ria is our relationship manager with IIFL. So I'll just give a little bit of insight just to sort of corroborate further the words that Shojit uttered. Our reading of India is that the changes that have taken place in India over the last decade, and specifically I'm referring to the networking of the country, not just through broadband, but also through low-cost airlines, a better highway network, the rise of GST, the rise of cloud, mobile, and SaaS. What this has done is it's created a new breed of businesses who are growing free cash flows at a very healthy rate. You've heard us say this in the context of PMS as well. But what we are now saying is down the market cap order, not just in the Nifty, but reaching into small cap as well. We're seeing high quality businesses growing free cash flows at 22-23% consistently. And at the same time, the Indian stock market is not being able to discount these businesses properly. They're not being able to understand why these businesses, which are not sort of historically household celebrated names, right? Many of these businesses are not celebrated names from, say, a decade ago or 2 decades ago. These are companies that have been born in the last 10 to 20 years. They've done exceedingly well in capitalizing on the changes in India, growing their free cash flows at 22, 23, 24%. And what we are seeing is the stock market is undervaluing these franchises. The valuation between the free cash flow growth and the growth in valuations is a good 5 percentage point alpha. And the hard work that Krishnan and the quant team have done over the last couple of years has allowed us to create a process, the MeritorQ approach. MeritorQ approach traps this alpha, traps this extra return for our clients. And as Shojit was saying, we felt that rather than bringing this approach to market through the PMS approach, it's better to try this in the portfolio construct. We took a SEBI RIA license. Krishnan is the registered investment advisor in Marcellus' subsidiary. And we thought rather than using the PMS approach, let's also use the SEBI RIA license to make this portfolio available to a wider group of people than just those customers. In PMS, as you know, only customers with 50 lakhs or more can do it. So without further ado, I'll request Krishnan to take you through the investment process, how it works, the mathematics, and what sort of returns can this generate for you. Krishnan, over to you.
Thank you, Saurabh. Good evening, everyone. So I don't think I'll delve into the product, the philosophy as such, right? I think Saurabh has given a very good context. But what I'll do is give a brief overview of what we are doing here in MeritorQ and how it will benefit you as investors. If you invest in this strategy. So again, maybe just to set some context, right? The way you can understand MeritorQ is simply as a checklist. And what MeritorQ as a strategy we are trying to do is follow the simple checklist of good investment rules to reduce chances of making bad investment decisions. And all of us, I'm sure, must have used a checklist at some point in our lives. For example, if you think about lists, a simple grocery list, right? A list for buying groceries, or a simple daily to-do list, right? Now, why do we need this list, right? Simply because we are all human beings, and even the best of us are not perfect and have limited memory, right? So even if we remember, we are not thoroughly consistent, right? So it's impossible for us to be perfect in all the time and consistently. So checklist, what this tells us is checklist is important in activities which are complex and also where there are too many factors which can influence the results. For example, just taking this example from our aviation industry, the complexity of the modern commercial liners. Airliners have grown to a point where it is difficult for a pilot or even a co-pilot to memorize and handle all the complex task of flying a big airplane, a civilian airplane, safely and reliably. Today, airline pilots, in fact, rely on checklists universally for even routine tasks like taking off, landing, taxiing on the runway, so on and so forth, right? And even dealing with emergency situations. Checklists in this context, they basically ensure that pilots follow all the procedures in completing the flying tasks or whatever tasks required while flying the airplane precisely and without making any mistakes. Checklists are also routinely used for other complex tasks. For example, if you think about surgeries, complex surgeries. And here again, the objective is to reduce chance of making unforced errors. So, in fact, if you this is discussed in detail in a very well-known book called Checklist Manifesto by Dr. Atul Gawande, where it's kind of it's like mentioned in that particular book as an example, where if you just follow a simple but effective list of almost like a checklist of tasks, right, in operating theater before the surgery, like for example ensuring the hygiene, washing your hands, making sure all the equipment is laid out which is required for the surgery, and also making sure that again the patient is given proper medicine, that the skin is washed with an antiseptic, so on and so forth, right? Simply doing these so-called simple steps and following this checklist religiously reduces chances of again post-surgery infections and complications from again these kind of infections, right? In fact, a study which is mentioned in the book is if just the simple step of following this checklist, someone created this checklist and followed this religiously, it's reduced the chances of mortality from again post-surgery infections by around 66%. Why are we discussing this, by the way, right? The point being that just as with the grocery list or checklist in aviation, an investment checklist can make sure that we are applying all the checks that we need to do to make a good investment, that we are applying this consistently and without any exceptions. Also, investing, unlike in other fields, it is possible for bad investments to outperform over short term. Again, it's also possible the other way, that good investments can underperform, right? Again, over short term. And to take care of this, having a clear and effective process, or what we call as a checklist, is kind of the key in investing, to avoiding mistakes and consistently outperform. So let's take a look at the kind of steps we follow in our the checklist we have created for MeritorQ. So just to start off, as a first step, what we do is we remove companies which kind of misrepresent their accounting, right, or their accounts. What we call as companies, companies who are cooking their books. So we basically start with the BSE 500. So this would be the universe of 500 largest company in India, and then we remove companies through this step. So these companies, again, like I said, are either cooking their books, they have governance issues, accounting irregularities, so on and so forth. And again, the purpose of doing something like this is to kind of reduce our risk or our exposure to companies where there's a risk of permanent loss of capital. I'm sure many of you would know that a good investing is as much about avoiding wealth-destroying companies in your portfolio as much as it is about picking winners. So having this forensic screen helps us reduce risk of exposure to such companies. So once we remove these earnings manipulators, etc., we also again we have a screen where we remove companies with high leverage. Now, high leverage can be a double-edged sword. again, I'm sure, again, a lot of you would be aware that, high leverage companies can, unravel just as quickly as they rise, right? So that's one of the reasons. And because in MeritorQ, we would rather, have companies which can generate consistent returns for us. So again, that's the reason we remove such companies. The third step after the forensic screening as well as the leverage screen is so we also remove companies which are not consistently profitable. Again, this is to avoid cyclical businesses, right? Again, cyclical businesses, if you think about businesses in India, either commodity businesses like, for example, steel companies or, oil and gas companies, again, they have not demonstrated a track record of sustainable profitability, right? So again, this would be, companies which we would remove through this consistent profitability screen. Finally, we select cheap as well as quality companies while avoiding value traps or avoiding overpaying for quality, essentially. And in the process, we also, as a last step, assign higher allocations to more undervalued companies in our final portfolio. So this sequence of steps which we talked about, right? The sequence of 5 steps is what you can think of as a checklist which we follow in Meritor.
I think it's worth breaking that down, Krishnan. So, so folks, the checklist Krishnan took you through. The first 2 steps are negative eliminators. Basically, we're getting the naughty companies out, people who are cooking their books, people who have risked up their balance sheet to levels that we believe are intolerable. It's the last 3 steps which are the positive identifiers. And as the presentation wears on, Krishnan will show you the return that you can attribute. One of the benefits of quant investing is you can actually figure out each step of the checklist. What is the return attributable to it? It's an astonishingly heavy part of the value which gets attributed actually to the first 2 layers itself. That the company is clean and the promoter hasn't risked up the balance sheet. The totality of the approach and the fact that it's applied nervelessly, emotionlessly, day after day, week after week, is what makes this approach powerful. In contrast to, say, qualitative investing, where, as you would have heard from us in thousands of webinars, where we are using our judgment. Here we've turned our judgment into a set of quantitative rules courtesy Krishnan's skills. And Krishnan then runs the algo year after year, and he'll now take you through the results that the algo provides. Back to you, Krishnan.
Thank you, Saurabh. So I'll talk about the results in more detail in the last slide. But suffice to say that these rules which we talked about in this checklist, what we call as a checklist, have been again rigorously validated over 16 years, right? And when we say rigorously validated or tested, essentially we have done a back test using the data as of that point, and created portfolios for these set of groups which you see here for this checklist. So yeah, we'll jump to the results, in the last slide. But to just move on. Okay, now many of you would have a question, right? Why do we select again good undervalued companies or quality undervalued companies in MeritorQ? Why this particular combination, right? When we think of MeritorQ as a portfolio, you can just think of it as a portfolio of underdogs, right? And again, underdogs, you can think of it as a situation or an individual or a team, which obviously has, good potential, but again, however, people don't have a lot of expectations around it, right? So the expectations are low. And, I think the one nearest example and maybe the classic example of underdogs, which I think most of you would relate to, would be the 1983, the World Cup winning Indian cricket team. And again, prior to the tournament, this is just an example of how underdog the team really was, how much of an underdog the team really was. So prior to the tournament, the India's return ticket. Return ticket from the tournament was booked on 20th of June 1983, whereas the finals and the semi-finals was scheduled for 22nd and 25th June. So forget even people having a low expectations from the team management itself did not did not think that or they were not expecting to cross the group stages of that particular World Cup. The and if you then go back and check what happened on the coverage side. So BBC, which was the the sole broadcaster around that time, so they did not even cover the first match played by Indian cricket team, and also the match with Zimbabwe. And if many of you might recall, that was one of the greatest innings played by Kapil Dev. Where he scored like 175 against Zimbabwe. Even that match was not covered by BBC. Even though there were two other matches, the West Indies Australia match and the Pakistan England match, which was again covered by BBC on the same day. The crux being that again, a lot of people, whether they were within the team or even the people who were outside the team, the general public, they were not expecting India to do well, or and we all know the final story. They eventually India, led by Kapil Dev, they pulled off a stunning upset. Going into the finals where they defeated the two-time world champions of that time, West Indies, by 43 runs, and eventually they won that tournament. So again, this unexpected victory is often cited as an example of how investing in underdogs can pay off, as these types of companies or assets, may have potential for significant price appreciation. The potential basically comes from the fact that they're obviously good, right? So they have the potential, but again, if they're able to outperform the expectations, even better, right? So in a similar way, right, when we think about the companies in MeritorQ, they can in a similar way we can think of, like I said, a portfolio of underdogs, and investing in underdogs can often pay off for investors because these companies have significant potential.
And this Krishnan, the point will become clearer. Just go into the rebalancing piece. I think the point will become clearer. Because I think I can see from the comments most people are not being able to grasp the point. Let's get into the rebalancing piece. I think.
Sure. So I'll just so should I just move to the rebalancing slide?
Just move to the rebalancing slide, because I think it's worth explaining how the rebalancing process works.
Okay. So again, I just wanted to touch upon this, the way we are, the summary of, the rules, whatever we have talked about, the checklist, so on and so forth. And like I said, right, I don't think I need to repeat. So we start from the 500 companies. We have our filters on the forensic screening, or the leverage, or the consistent profitability, and then we select the good undervalued companies. So we select 35 such good undervalued companies. And then, like I said, we allocate, we have higher allocation towards more undervalued companies, right? So, we do this whole process, right? From the start to the finish, we do this twice in a year, right? And, this whole process of, again, running this whole process from start to the finish twice in a year is what we refer to as rebalancing, right? So, and this is what we'll discuss in the next slide.
And folks, for the intermediate steps, if you want to know how we do forensic accounting, read our book Diamonds in the Dust, easily available on Amazon, or you can buy a pirated copy on any footpath in India. Diamonds in the Dust will take you through the forensic algo Krishnan was referencing. We've laid out in great detail. The book has sold by the lakhs. We've given you names of around 15 fraud companies that we caught. Many of the promoters are now have now been apprehended. They're either in jail or they've run away from the country. So the first step of the process, the forensic process that some of you are curious about, we've laid it out in the public domain in Diamonds in the Dust. Krishnan, back to you.
Yeah. So, again, in this slide, again, we'll just, talk about rebalancing, right? Like I said, we go through this checklist, or, the whole, the process from start to the finish twice in a year. And we do this in April and October. So the first trading date of April and October are the only 2 dates where we tinker with the portfolio. And, whatever, changes we need to do is or the refreshing is what we call as rebalancing, right? An easy way to understand rebalancing are these annual IPL auctions, again, which garner media attention every year. You can think of these as rebalancing exercise by each of the IPL team, where each year, each of the team is trying to put together, almost like, the best team, with, from a global talent pool. Again, with, good players, but also new emerging talent, right? But again, all of them obviously have this limitation of their own budgets. They, each team has a limited budget. So once all these teams, they select a player, they go through the auction in that particular year. Each player is then given a chance to prove their potential, right? And if a player's performance matches the money or the money that was paid, or the money, the price at which they were bought, they're retained for the next season. Otherwise, they're put back on block, right? So again, I was just reading the other day. If you think about examples here, a player who comes immediately to my mind is Ishan Kishan. He was bought by Gujarat Lions for 35 lakhs in 2016, and but his current going price this season was somewhere around 15 crores. And there are other examples like Rishabh Pant, so on and so forth.
Krishnan, the example people might identify with is Mohammad Shami. So I remember exactly a year ago, Mohammad Shami was acquired by Gujarat Lions for 6 crores. And I remember reading on the cricket websites that Mohammad Shami at 6 crores is a very expensive buy. And generally, Gujarat Lions were castigated for spending too much money, right? So it's a very familiar castigation. So everybody said Gujarat Lions zyada kharcha kar diya. They have spent too much. And specifically, the Mohammad Shami purchase turned out to be a master stroke. Right, at every critical juncture for Gujarat Lions, Mohammad Shami stood up and delivered. The 6 crores turned out to be a bargain. And as everybody knows, Gujarat Lions won the IPL. They were comfortably the strongest team in the IPL, and that's a great example of a team rebalancing itself, using its money wisely, using its budget wisely to buy high quality players at sensible valuations, and winning the title itself.
Yeah, that's a great example, Saurabh. So again, thinking about these auctions, and again, the way these teams are rebalancing themselves, right? With new players coming in, and underperforming players moving out. In a similar way, you can think of what we are doing in MeritorQ with our with our rebalancing exercise, right? Rebalancing helps to improve returns by taking advantage of opportunities to buy low and sell high. Right, this is done by regularly picking up undervalued stocks and selling those which have reached their fair value or are above their fair value, or even if we don't sell them, we'll at least reduce their weightage in the portfolio, right? For example, if a current portfolio company has outperformed from the last rebalance, but it again goes through our checklist. So again passes through all the the steps in our checklist. It goes through all our filters, but we would end up underweighting it, right, during the current rebalance. And because we the way we like we said, the last step in our the whole portfolio construction processes, we allocate more to undervalued companies, right? And this weighting within the portfolio, allocation within the portfolio, is done basis value, or the degree of undervaluation, which we measure using free cash flow yield. Right. So it can also happen that the rebalancing, the process we talked about. It can also happen that more attractive undervalued stocks, they can also be picked up, right? So we sell down the overvalued stock, and we pick up the more undervalued stock, right? The other benefit of rebalancing is it helps us reflect any change in information on the fundamentals of these companies, right? So if you think about the steps which we have, the forensic screening steps, it's based on some 11 or 12 ratios which we have come up with, which sort of talked about, which is mentioned also in Diamonds in the Dust. So those ratios are based on the fundamental characteristics of these companies, right? So for example, their the cash flow generation potential, right? Their profitability, right? So all these numbers do change, again, every 6 months. And as they change, we recalculate these ratios. We recalculate, for example, the company's leverage, etc. And this is then reflected in the filtering steps. So, for example, if a company was, clearing our filtering steps say 6 months back, and if it's not clearing now, it will be removed in the most recent rebalancing. Right. The other, maybe a very small, benefit, but another advantage of rebalancing is because we regularly get rid of overvalued companies, it prevents any single company or sector from dominating the portfolio. Right. And what we have seen, again, basis, the backtest which we have done, the 16-year backtest we referred to, is no single company, gets an allocation of more than 12% ever over the 16 years. Right. So when we, again, just going back to, rebalancing, and how it helps, to put it in a nutshell, right? When you, rebalance regularly, with these 35 to 45 stocks, which we pick in MeritorQ, what this allows us to benefit from is, again, the rise of these undervalued stocks. As they rise to their fair value, the price appreciation, the investors obviously get a benefit from that. It helps us to reflect new information, and obviously also control for risk, right? And again, when you think about all this, when you put all this together, it helps investors to maximize their wealth creation potential. Like I said, in MeritorQ, we have, the allocation is done basis free cash flow yield. And some of you obviously might also have this question, right? Why do we go with the 6-month rebalancing frequency? The simple reason is we have tested, different options, right? So we tried, a monthly rebalancing, almost even a quarterly, other rebalancing frequencies. But what we found is if we, as we rebalance more often, the portfolio churn increases, right? And if you think about, again, for investors, from an investor point of view, frequent churn is not a good thing, because you end up paying, additional costs in terms of transaction costs, your demat charges, so on and so forth, and also
I think let me just. I think this is a point. This is super important to MeritorQ. So we've already signed up around 130 clients, and I remember the first 20 or so clients said, "Boss, why don't you rebalance every day, every week? We've signed up with you guys. We were expecting to see lots of action." And we showed them the simulation, right? If you or we trigger rebalances every day, every week, we are going to create brokerage cost for you and capital gains cost for you without meaningfully improving your performance. So Krishnan did the simulations. The ideal rebalancing frequency is established as every 6 months, right? There's enough fundamental data which comes through in a 6-month period to materially improve the quality of your portfolio by rebalancing. But we, at the same time, we're able to keep and check your brokerage costs and your capital gains costs. So those who want to see a portfolio rebalanced every day or every week, I'm afraid MeritorQ is not going to be your cup of tea. This is a portfolio for more patient investors who understand that fundamentally oriented investing does involve waiting for a degree of time before you fiddle with the portfolio. Krishna, let's move forward.
Yeah, so the churn which we have seen based on our, the backtest is somewhere around 50%, right? And this is what we should also expect. The investors should also expect going forward. So again, we just wanted to, talk about a bit more about, again, the benefits of, what we are doing here in MeritorQ. So if you look at, the classic investment advice, right, which is given to all investors, which is to buy low and sell high, right? And I think this is, again, a universally accepted wisdom, not just for stocks, right, but, in any kind of investments, right? So if you have to make money anywhere, the universal principle you need to follow is buy low, sell high, right? So, again, while common sense suggests that this should be the pursuit of every investor participating in the market, often the opposite happens, right? And this is where, again, the noise, which surrounds all of us, which none of us can escape from, whether it be, the noise coming in from, people around us, the TV channels, experts, so on and so forth. that kind of pulls us away from making the most optimal decisions, right? So ideally, you would expect people to sell, or sell at the market highs, or the other, and also the conversely the other way around, buy at the lows, right? But usually the converse happens because of the noise, and also because of the emotional biases, right? Because all investors are human beings, and these biases and the noise kind of take the investors away from this buy low, sell high strategy, right? So if you think about this, there are again many ways this kind of manifests itself. One common bias, when you think about emotional biases, is this fear of missing out, right? This can lead investors to rush into a purchase even if the asset is overvalued, because they fear that they might miss out on future returns. Another common bias, and this is very commonly seen, that investors tend to over focus on certain parameters. For example, they are more concerned about the company's business prospects during a bear market, right, or when things are not going too well. But conversely, they are less worried about a company's corporate governance at the top of the cycle, right? Whereas if you again just think
Krishna,
about it for a minute, right?
Why don't we actually show them the results? Because while the point you're making is very fair, I don't think people will be able to clock these points until we show them the results of what MeritorQ produces, right? So let's get into the results, the 16 years of simulation, and then we can come back and dwell on the benefit of doing MeritorQ. Just move forward.
Sure. So here you can see the outcomes of following this automated checklist. The data here is, again, like I said, from a 16-year historical backtest. The returns here, however, are stated, again, gross of any transaction costs or fees, but they are again stated in price return terms, right? So please remember, again, when we say, when you're shown the returns here, we are, again, stating this gross of any transaction cost or fees, but in price return terms. So the chart on the right shows that each of the steps in whatever we talked about in MeritorQ, the checklist on slide 1, each one of those steps, that obviously, it tells you what the magnitude of the contribution to the overall performance, and you can obviously see that each one of these steps contributes positively, right?
In fact, if you see, folks, this is the first step Krishnan described, right? So if you had just bought the BSE 500 equal weighted, this is 16 years of data, right, Krishnan? 2006 to 2022.
Yes.
2022. 16 saal, last 16 saal mein, had you bought the BSE 500 equal weighted, you would have made a mere 8%. But applying our forensic algo immediately juices up your return by another 5.5%. So 8%, 7.9 jumps to 13.5, right? Just forensic alone gives you 5.6% extra return, right? Why does it do that? As I said, read Diamonds in the Dust. You'll see all our accounting checks there. So one simple accounting check, which has never let us down, is if you see a listed entity where accounting fees are growing faster than the company's revenues, and there are several like that in the Nifty. Just in the Nifty itself, there are several listed entities where accounting fees are growing faster than revenues. That's a sure shot signal that the auditor is being gratified by the promoter, and things are going to get very nasty very soon, right? There are 10 such accounting signals Krishnan is using to juice up the return from 7.9 to 13.5. So pehla step is get the naughty people out. Several people in the Nifty, obviously in the BSE 500 there are naughty people, that was a given. But what I think what's stunning about India is we continue to have very large companies doing very naughty things. Then the next jump in value, 13.5 to 18.3, right? Little under 5%. Krishnan, if you could just explain how we juice up returns from 13.5 to 18.3.
Yeah, so like I said, right, so this step is where we are removing companies with high leverage. This leverage metric which we're using is debt to equity, right? So essentially we are again, like I said, right, leverage is a double-edged sword, right? So investing in companies with very high leverage, right? And we look at leverage with respect to other companies in the same sector. So again, it's a again, investing in high leverage companies is a risky proposition, firstly, and it's not also a good investment proposition, right? And that's what you see. The other screen, which is also included here in this step, is the consistent profitability, right? We are looking for companies again which can generate ROCEs, or the return on capital employed or return on equity, consistently over the past few years, right? So the emphasis is on consistency rather than on the amount, right? Because we are anyway going to look for good profitable companies in the last step when we select for when we do the selection in the last step. Here the focus is number one on avoiding over leveraged companies, and number two, look for companies with consistent profitability. And no surprise again that you see when you apply the screen, you see this the bump up in your average returns from 13.5 to 18.5, right? And with these two screens, the forensic screen which Saurabh talked about, and this the leverage and the consistent profitability screen, we are kind of removing almost 40%. Sorry, not even 40%. So it's almost like 80% of your the starting universe. So we are after applying these filters, these three filters, we are left with somewhere around 80 to 100 companies.
Now, if you could help people understand, right? So from 7.9, we applied forensic, we got to 13.5. On 13.5, we applied leverage and profitability to get to 18.3, right? Where does the next 3% jump from 18.3? We ended up at 20.4, 21.4. Where does that 3% jump come from?
So one is selection. So we are looking for, like I said, undervalued and quality companies, right? And the undervaluation is again is measured using free cash flow yield. So companies with free cash flow yield are considered to be more undervalued, right? Essentially, we are saying that companies which have higher free cash flow generation potential versus the price we are paying for, we are saying that those are more undervalued, right? So companies which are more undervalued and which are again have a good profitability as measured by their return ratios. So we select basis that we select 30 to 35 companies basis that, and that gives you the bump up from 18.3% to 21.4%. And then when we allocate more to undervalued companies, i.e. companies with higher free cash flow yield, you see that additional increase from of 40 bips from 21.4 to 21.8.
So folks, let me explain this final selection point. This is central, right? And if you think about Marcellus's approach in our qualitative portfolios, in our PMS portfolios, and say in books like Unusual Billionaires, Marcellus' approach is actually so far forensic screening, ditto, right? And qualitative as well, we do forensic screening. Look for consistent profitability. Yes, we do that in our qualitative portfolios as well. Where MeritorQ is different is the selection layer and way Krishnan's constructed it is different from the way we do it in our qualitative portfolios. The way Krishnan's done it, let me explain using a simple example. He's saying, I'm not just interested in the boys and girls in the class who have great IQ. I want to see them having great IQ, but I also want them to be good in sports. So I'm going to give them a weightage for having great IQ. I'm going to give them a weightage for being good in sports. And students who are able to blend IQ and sports, blend Dimag and sports, I'm going to put them in the portfolio. Or in other words, I want the company to be good on quality, right? Consistent profitability Krishnan wants. But at the same time, I also want them to be reasonably priced on price to free cash flow. So price to free cash flow mein acha score, profitability mein acha score, I end up buying them, says Krishnan in MeritorQ, right? So in our qualitative approach, we would end up buying the guy with Nobel Prize potential, right? Super IQ chahiye in our qualitative approach. Krishnan's approach, he's blending IQ, intelligence, with sporting price, he's blending quality with price, and he's giving you a portfolio of roughly 30 to 50 stocks, which over the last 16 years have compounded at around 21%, 21.5%. This is gross of fees, as Krishnan said. This is where this sort of disciplined approach is very, very useful, right? He's written a couple of newsletters, which if you guys are interested, we can share with you, where he's shown how over the course of time, over the course of time, this approach gives you consistently sensible returns. You can see that in that orange chart, right? And if you, Krishna, now go back to the preceding slide. Just go back to the preceding slide where you're explaining mental biases and how people get damaged by their own investing behavior. Right. So Krishna was trying to explain to you how in standard investing, right? In standard qualitative investing, people watching, TV, reading the newspaper, listening to their broker, doing buying, selling, it is very, very difficult to do what Krishna has described to you. Because as you would have seen, most people you and I know would have bought Yes Bank in the last 4 years before Yes Bank blew up and fell 95%. Most people I know bought crypto right at the climactic phase of crypto. Most people I know bought Reliance Power right at the IPO and lost everything. The human mind is most vulnerable to crap investments at the time exactly when the crap investment is most dangerous, right? And this facet of investing is the most damaging facet, I think, for the average investor. They will buy the most dangerous stock when it should be bought least, right? We've seen it with crypto. We've seen it in 2000. We saw it with Reliance Power. We saw it with DHFL. We saw it with ILFS. We saw it with Yes Bank. We will see it again, right? The world doesn't change. We'll see it again this time, I suspect, with PSUs. People will buy PSUs at the worst possible moment and end up losing a lot of money. The way Krishna's constructed MeritorQ is exactly to avoid that emotional bias, right? And the third panel is showing you how he's helping you avoid emotional bias by helping you get in at the right time, get out at the right time. Why? Because there is no emotion in this. This is a computer programmed by Krishnan. The computer is rebalancing your portfolio every 6 months, keeping you out of trouble, helping you compound at a healthy rate. Krishna, would we have any example stocks that we can discuss?
So we can, I don't have a slide around it, but yes, I mean, we can discuss, a few stocks.
So let me take an example. So there isn't that much overlap between MeritorQ and Marcellus's qualitative portfolios. I think roughly 10% of the stocks in MeritorQ, roughly 10% of the stocks in MeritorQ are in Marcellus's qualitative portfolios. But there is one stock common, right? And it's an easy way to help you understand where this differs from our qual approach. One of the common stocks between MeritorQ and Marcellus's qual portfolios is Dr. Lal Path Labs, right? So as everybody I think knows, right, if you read our newsletters available free on marcellus.in, Dr. Lal Path Labs fell 50% in the first 6 months of 2022. And our research team spoke to around 30-40 doctors, spoke to six path labs. Our client base is pretty big. So within our client base, plenty of doctors and path labs. And basis their inputs, our qualitative research team heavily ramped up the position in Dr. Lal Path Labs through July through August, right? I think we must have about 450 crores of it basis qualitative research, right? And in qualitative research, as you know, right, we're going to go and speak to not just the management team, but ex-employees, current ex-employees, current suppliers, current customers, competitors, and build a picture. What is the company's moat? In quant investing, in MeritorQ, we can't do that because it's a quant approach, right? So how does MeritorQ work? Krishna, if you could just bring up that screen, the checklist again. I'll just use the checklist to help the people, public understand how quant investing works. So yeah, if you see the MeritorQ checklist, the first thing we will check for Dr. Lal is forensic accounting, right? So no problem here. This is a high accounting decile. It's actually very strong on accounting, strong accounting score. Then we check leverage. No problem here either, right? Debt-free company. Then we go on to profitability. ROCEs are 35%, gross profit margin 40%, consistently above average profitability over the last 3 years, right? Strong on profitability, no debt, good accounts. And finally, on price to free cash flow, as we discussed, it got absolutely smashed in the first 6 months of 2022. Price to free cash flow came off. It's marginally recovered, but still looks very attractive on price to free cash flow. And therefore, the quant algo sends a signal that Dr. Lal should be part of the portfolio. And 6 months hence, in April, the quant algo will revisit the situation and make a call on Dr. Lal again. No human intervention, completely done quantitatively. I think we should stop there. We'll hand over to our folks back at IIFL. If you guys want to moderate the Q&A, up to you how you want to do the Q&A.
Thank you, Saurabh. So we do have a couple of questions from our friends, partners, and employees here. So we'll take few questions one by one so that you can help us in understanding those questions and replying those things accordingly. So just before we begin, I would like to inform few things. As it is already shown in the screen, the entire portfolio of MeritorQ will cost us on an annualized basis 2.25%. This is the charges what fund manager charges, and it is debited on the quarterly basis. Minimum investment is 10 lakhs. So anybody who loves to invest should at least start with 10 lakhs and increase thereon. Entire this portfolio is currently available on our IFL Wealth Desk platform. So in case anybody wants to invest, you have to just go through the IFL app through which you can able to invest in the MeritorQ portfolio. So now let's take a few questions from our Q&A box. Anybody who is interested to have any, ask any kind of a question, please feel free to ask in the Q&A chat box. So Saurav has already answered about some similarities on the portfolio components as well as his PMS. So I'll repeat the question once again. What does MeritorQ do have some kind of a same strategy we have used for Little Champs?
No, so Little Champs is a qualitative portfolio. MeritorQ is a quant portfolio. In Little Champs, as part of part of creating an investment universe for Little Champs. So Little Champs, although it's a 16 stock portfolio, the investment universe is around 30-35 stocks. To create the investment universe, we use the forensic accounting algo that Krishna has referenced. We use last 6 years of profitability. But Little Champs, the way we research the company is completely different. And Little Champs ka typical stock market cap is only $1 billion, only around 7,500 crores. Krishna, MeritorQ typical market cap would be how much?
It can go up to the biggest stock, if for all we can say, right? Because this is the all cap per universe we start from.
Yeah. So I think as Krishna is saying, MeritorQ ranges from small stocks all the way to companies which are in the Nifty 50. Little Champs is a small cap portfolio. Little Champs, it's research, qualitative research. MeritorQ is quant approach.
Thanks. We'd like to take the next question here. We have got many questions. How long do you see that one customer should invest in a portfolio?
How long? Good question. Please don't invest in any of our portfolios in MeritorQ for less than 3 years. Right? A lot of people call us up and say, "1 साल में पैसा बनेगा क्या?" नहीं बनेगा 1 साल में पैसा. Right? If you don't have a 3-year horizon, don't invest in our products. I would strongly recommend you don't invest in our products. If you don't have 3 years, if I was your friend, I would tell you, don't invest in any equity products if you don't have a 3-year horizon.
Thank you, Saurabh. There is one more question. In current market valuations are currently very high. Should we wait for some cool off?
I mean, I keep hearing people say this, right? Valuations high, valuations low. I'm not so sure that given the sort of companies you and I are looking to invest in here, which is high quality, clean companies, they're going to be waiting for the market valuations to cool off. So just to sort of, let me put it in a different way, right? My son is in class 10, right? He's at an all-time high. Last year also he had an all-time high. He was in class 9, right? The year prior also he was at an all-time high. He was in class 8, right? And so on and so forth. I'm sure all your kids are also like that. Every year they hit an all-time high. Usually high quality companies hit all-time highs pretty consistently, right? So this quarter, for example, HDFC Bank's profits were at an all-time high. Next quarter as well, unless something disastrous happens, HDFC Bank's profits will be at an all-time high. So with high quality investing, this all-time high business is going to happen most of the time, and hence waiting for valuations to cool off and then investing, there is no basis. Christian's algo is doing that for you. Christian's algo is constantly searching the market to say, where can I find really high quality companies who are also sensibly valued from a price to cash flow basis, right? You don't have to worry about the market because his algo is doing a lot of heavy lifting for you. And if you go back one slide, we'll just look at the orange line. The orange line is his algo. If you look at the orange line, so just go back one slide. Just go back to the slide where we can see. Just look at the orange line. No. Just go to the slide ahead, please. Yeah. So just you can see the orange line, right? The orange line is MeritorQ. You can see in the orange line, there is no point waiting for valuations to cool off. So if one of those dips is COVID. If you see just in 2021, the main precipitous drop is COVID. And if you had we zoomed into 2008, there would have been a precipitous drop in 2008, right? To the extent that there are occasional pullbacks, there is already a pullback you can see in MeritorQ, but already you can see the rebound has started coming through. So don't try to time the market, folks. It's a very bad idea. It's a common mistake in our country. I see market timers everywhere. It's a form of hallucination, I think, trying to time the market. I would strongly recommend that you don't try to time the market. Invest in a strategy like this, where the algo itself is finding for you good quality at a wajib dam. And as you can see from the orange line, it's been relatively consistent in its progression over the last 16 years.
Thank you, Saurav. The same one more question from Vikas ji. This is a different strategy for small case and PMS. Sir Saurav has already updated about the PMS is a different strategy, and advisory portfolio which we are currently having on Welldesk platform, it is a different strategy. So moving on to next question. Folks, I will just try to eliminate few questions which are repetitive in nature. There is a question pertaining to IT companies laying off employees, and India and global companies are.
This sort of thing I answer on TV channels. I'm happy to say it, but the point here is to give you guys a perspective on quant investing. There's all sorts of hawabazi in our country. IT mein hawabazi hoga. Somebody's asking about Geo Financial Services. Somebody else will ask about Coal India. So just if you want a general sort of point of view on these subjects, just go to YouTube. Our videos are easily available. Most of the stuff is noise, right? Grasim ghus raha hai paint mein, Geo ghus raha hai financial services mein. Global में supposedly global recession shuru ho raha hai. Most of this stuff is noise. It's not related to fundamental investing. Fundamental investing is what Krishnan is showing you on the left hand side of the screen. Is the promoter honest, right? Forensic screening. Does the promoter have business capability? Usme akal hai kya to run a business properly? That's the low leverage and consistent profitability, right? Is he honest? Does he have business capability? Akal hai kya usko business chalane ka? Third fundamental layer is, given that the fellow is honest and given that he has business capability, how do I put the company in a portfolio at a reasonable valuation? That's the selection layer Krishnan has created. That is all that matters in investing. Clean promoter, akalman promoter, capable promoter, and hey, available for you at a reasonable wajib dam, right? What doesn't matter is kiska chacha, kiska mama, kis sector mein ghusa hai, रिसेशन कहाँ पे शुरू हुआ है, वॉर कहाँ पे चल रही है, IMF ने क्या बोला, वर्ल्ड बैंक ने क्या बोला. All of that stuff has zero relevance for investing.
Thank you, sir. I'll take a few more questions pertaining to the portfolio. Dear friends, we are avoiding the questions which are pertaining to any particular stocks because this will eat up everybody else's time. So anything related to the portfolio per se questions, I'm taking those questions which are more or
so one point to explain to everybody, right? Perhaps you guys are a little apprehensive कि portfolio आ जाएगा and मेरे को पता भी नहीं चलेगा क्या ले लोगे. नहीं, ऐसा नहीं होगा. What Krishnan will do is he's created the algo. We will be your investment advisor. You will be shown the portfolio by IIFL. You will have a choice कि लेना है या नहीं लेना है. If you choose to take the portfolio, you click on a button and the portfolio will come into your demat account. If you choose कि आपको नहीं चाहिए, then you can reject it, right? So ऐसा नहीं कि without telling you, we will be buying stocks, or without knowing you'll be buying stocks. You will have full visibility what is the portfolio recommending. If you like it, you accept. and the portfolio uploads for you. You don't like it, you don't accept, your portfolio stays wherever, whatever you want it to stay. Right? This is a very important distinction. PMS.
Yeah, but the one thing
Haji, bolo Krishnan.
So the one thing I wanted to add there was, I think it's recommended not to pick and choose stocks, right? So it's okay if you don't like the portfolio, don't invest. And if you like the portfolio, you go ahead, right? But again, I don't think it's recommended, that you pick and choose stocks after seeing the portfolio, what you want to do, which ones you want to invest in, not invest in, because the portfolio has been created as a whole, right? And that's how, those are the routes we have tested and, the returns we are showing. Right now, if you take individual calls on what to include and what not to include, then it kind of defeats the whole purpose, right? And then you should not expect the returns which we are showing here on this slide.
Yeah.
So here the Mr. Krishnan is trying to say, please don't become a super fund manager. We already are having a fund manager who is taking care. He's already charging us fees. So even after paying the fees, if you are not able to use his skill sets, then there is no point. I hope, Krishnan, you're on the same page now.
Yeah, so I think Viral, you have got it right. Folks, in PMS, you can't do this. One of the benefits of this MeritorQ structure, one of the benefits of the advisory structure is you get to see the portfolio and fill up button daba ke lete ho, right? What you can't do is, Krishna is saying, you can't pick and choose within the portfolio. However, in PMS, you can't do that. PMS, you give us the money, we buy the stocks on your behalf, right? So this structure, not only is the ticket size lower because it's an advisory structure, 10 lakh, 10 lakhs versus 50 lakhs. Not only is the ticket structure lower, significantly lower, your ability to see what you have been given, what medicine Dr. Krishnan is giving you, your ability to see is greater. Whereas in PMS, it's like you are put on general anesthetic and then we do whatever we have to do to your portfolio.
I'll reply a couple of more important points here. Mr. Uma Shankar has asked, any lock-in period? No, sir, there is no lock-in. You invest today, you are allowed to exit even after on the same day or even after a couple of days. But as Mr. Saurav has said, minimum 3 years of horizon, you need to have that kind of patience to see the sizable returns.
Stock market is nothing but a medium to transfer wealth from the impatient to the patient. Jitna impatient log, the more impatient people there are in India, the richer the patient people will get, right? So the more khujli you have for trading, the more rich you will make somebody else in India.
Quickly, we can take those questions related to the demat account, etc. So I'll just quickly summarize a couple of questions here. Firstly, related to the fee, it's 2.25% on your average daily AUM. So the first time when you pay, it is obviously a quarterly basis, and going ahead, it is on the daily average AUM and not on the 10 lakh rupees which one has invested. That's one. Secondly,
Ria, your voice is echoing. So in case you have double voice, or in case you have to just check it out.
Is it better now?
No, it's not better, but we have a very limited time. It's 5:03 now. So, yeah, Rishi, please go on.
Yeah. So quickly, and considering the demat account which one person has asked, it's eco. So I guess I'll just type it down. We can take the portfolio questions. I'll just type down the answer in the chat box so that everybody can see.
Thank you.
And I think lots of people are saying, can NRIs invest? Yes, I think Viral, NRIs can invest, right? Viral?
No, sir. No, NRIs cannot invest in it.
NRIs can't invest. I'm sorry.
So I think so, sir, we have covered all the major questions which were related to the portfolio. In case anybody has any particular questions or they have any queries, they can reach out to their relationship manager. They can then come to us and we can be able to help you how to go about it.
Thank you very much. Thank you, Viral.
Thank you, sir.
Thank you for all day.
Thank you.
Thank you, everybody. Have a good weekend. Bye.
Happy weekend. Bye.